Hey everyone, Iggy here from the Investing Iguana. Let's have a chat about something that's been buzzing in the Singapore investing scene, the big NTTDC REIT IPO. Remember all that hype 2 months ago? The promise of a juicy 7.5% yield from a blue chip GIC-backed data center REIT. But now you look at the price and what happened? Why is it sitting nearly 5% below its IPO? And is that a screaming buy or actually a warning flag? Let's walk through this together. I'll break this down section by section, just like the article over on my Substack, but with a bit more chat, less finance speak, more real talk. And if you're new here, I help folks in Singapore figure out investing decisions without the stress, with lots of content right here on YouTube and over on Substack. Okay, big picture first. NTTDC REIT hit SGX in July 2025, the biggest IPO since 2017, with deep pocket sponsors, NTT, GIC, and all eyes were on it. Investors expected fireworks, but what we got was more like damp sparklers. Even with that 7.5% projected yield and the whole data center plus AI boom narrative, the price fizzled almost right away. As of today, it's stuck at about US 0.955, a decent step down from its US 1 IPO. Let's rewind to that launch day. The IPO itself was a blockbuster. It was oversubscribed 4.6 times. GIC put in almost 10% of the entire deal, and on day one, the stock even touched your $1.03. Maybe you saw the headlines and thought, wow, I missed out. But then, the typical pop and drop. The price slid right back to IPO, and within a week, settled around $0.95. Instead of roaring demand, the volume faded, almost like folks were just cashing out, not sticking around. If you chart the share price and trading action, imagine a table here with a steady slide, you'd notice. Not only did the price never recover, it just drifted lower through August. The action suggested that while institutions showed up for launch, retail demand wasn't there. You know that feeling when everyone's excited for a new cafe, but after the grand opening, it's mostly empty? That's the vibe. So where are we now? Latest data has NTTDC REIT at about $0.955 per share, trading only around 5.9 million units daily. And here's a key stat, it's now at a price to NAV of just 0.95x. Yep, this means you're actually buying the assets below book value, which sounds like a sale, right? But when you look across to its competitors, that sales sticker is actually raising eyebrows. Let's compare the main players in the Singapore data center REIT space. A quick who's who. Keppel DC REIT, the local darling, trading well above book value with strong price gains. Digital Core REIT, a bit trickier thanks to tenant issues. Mapletree Industrial Trust, more diversified but still in data centers. And of course, NTTDC REIT. Picture this, if we had a table right here, it'd show NTT's yield way higher than the rest. 7.5% versus Keppel's 4.1%. Digital Core's 5.9%. Mapletree's 5%. So NTT looks like a bargain, but the price action says, not so fast. Ever notice how, if something seems too good to be true, you start looking for the catch? Let's dig into the guts of the REIT, its actual portfolio. NTTDC REIT owns 6 data centers, 72% in the US, 17% in Europe, Austria, and only 9% in Singapore. So, you're getting global diversification, especially into the US, where demand for data centers is still booming thanks to AI and cloud. The stats sound good. A healthy 94.3% occupancy, with leases expiring gradually over nearly 5 years. The customer mix is half hyperscale, think cloud giants, and half colocation, enterprise clients, so you're not putting all your eggs in one basket. But there's always a but, right? Going global means you're exposed to currency and regulatory risks overseas. Financial structure next. NTTDC REITs got gearing at 35%, which in plain English means they haven't borrowed up to their eyeballs. It's manageable, well within what SGX would call conservative. No big loan repayments due till 2028, and with some options to stretch that further. So, no real financial cliff coming soon. But here's the catch. The REIT committed to pay out 100% of its distributable income till at least 2027. For those who like regular payouts, music to the ears. But it means they're not retaining much cash for growth or surprises. In investment speak, high yield now, less cushion for bad times. Let's take a pause here. By the way, if you want to see all the exact tables, visuals, and the written story, everything's up on my Substack. The link's below the video. And if you're new, consider signing up so you get these deep dives right to your inbox, plus reference checklists and bonus guides. Back to it. Now let's talk investment thesis. Buy, hold, or avoid. First, the bullish case. The reasons you might want to buy. Valuation. At 0.95x book, you get the assets at a discount. For value hunters, that's usually promising. Sector growth. Data center demand is not going away. In fact, AI and cloud keep ramping up, and industry forecasts are wildly optimistic, like 22% annual growth out to 2030, even higher for AI-ready centers. Backing. With NTT Group behind this, you've got a sponsor with huge resources and a solid pipeline, which most small REITs can only dream about. But, and it's a big but, here are the risks. Execution. This management team is brand new, with no public track record. Remember Digital Core's headaches? Good assets, but execution can undo all the nice numbers. Tenant risk. 3 customers pay nearly half the rent. If one walks, income takes a big hit. In property, tenant concentration is always a double-edged sword. Market mood. Frankly, the Singapore IPO market hasn't been friendly to new listings. Even with fundamentals, investors seem to want proof, not promises. At this point, you might be thinking, so who is this for? Here's how I break it down, Singapore style. For income-focused folks, the 7.5% yield is tempting, but brace yourself. Payouts are semi-annual, so slower than some, and the price may stay meh for a while. If cash flow is your target, you could take a starter position, but size it small, maybe 2 to 3% of your portfolio. Be ready for bumps, growth chasers. If you're looking for capital gains, wait and see. Let management prove themselves first. Maybe until first distribution hits, or when you see more acquisitions and operations running well. The upside only appears if they execute. Conservative investors, honestly, sit this one out. You want stability? There's still too much unknown unknowns here with the new listing risks and high payout policy. Zooming out for a moment, how does this fit into the wider Singapore REIT market? Here's my honest take. SREITs have been under heat since 2022, with interest rates climbing and only the very best surviving. Just look at Keppel DC REIT's numbers over 3 years, still in the green. Investors are now pickier, no longer just buying any safe yield story. They want a proven record, not just a good story and a strong backer. So, looking ahead, what would actually turn NTTDC REIT around? A few big catalysts. First, payout. June 2026. If they hit expected yields, investor trust can rebound fast. Smart deals. Growing the portfolio with accretive acquisitions from NTT's stable. Operational wins. Renewing key leases, keeping occupancy high. Macro help. If rates drop, high yield plays like this get a spotlight again. But until these play out, I think the best stance is this. Cautious optimism, with strict position sizing and clear eyes. It's not a set and forget dividend play. It's more like a work in progress, where you set alerts and keep tabs. The discount could be your friend, but only if you're willing to monitor. For most, I'd call it a hold, maybe a selective buy if you're yield focused and like what you see. But patience is non-negotiable. Here's my personal Iggy style summary. What really matters isn't just the juicy headline yield, but whether management can actually deliver on those promises. Because, as we've seen, Singapore's market rarely rewards hype for long. My tip? If you nibble on this REIT, keep your position light, review after that first distribution, and always have a plan to reallocate if things go sideways. So, if you're planning your own move, pause, weigh the risk, and if you're still tempted, pace yourself. Anyone else watching NTTDC REIT or holding a different data center REIT? Sound off in the comments. I love hearing your take and questions. Before you go, if you found this helpful, join the Investing Iguana community as a premium member. You'll get early access to deep dives, monthly live Q&As, and practical Singapore-focused tools.